Okay, folks, welcome. Welcome to another exciting, thrilling, and scintillating SCORE presentation on a topic that is near and dear to every entrepreneur's heart. I don't care what kind of a business you have, whether it's a small business, entrepreneurial tech startup, or whatever. Raising money is one of your big challenges. In fact, it's probably one of the biggest challenges. Getting customers and getting money are the two biggest challenges that just about any small business has. I don't care where you're located or what kind of business it is. We're going to be talking about some stuff tonight that's a little different than the way you normally do these programs. But first of all, my name is Cliff. I am a lawyer by training. During the 1990s, I was the host of a PBS show called Money Hunt, which was the very first Shark Tank type show. We had entrepreneurs from around the country come on and basically have their business plans torn apart by some leading business experts, including myself and a bunch of ruthless and soulless venture capitalists. It was a fun show. You can actually, some of the old episodes are actually up on YouTube. If you go to YouTube and search for Money Hunt TV show, you'll probably see some of the old episodes. You can see what I looked like when I was 20 years younger and a lot thinner. And let's get that out of the way, by the way. I always like to wear this particular color when I do a presentation, and there's two reasons for it. One is it's a very good color for the camera. It works very good for me, but it also gives me the opportunity to begin these with absolutely a horrible joke, which is the last time any of you saw anything this big and this purple, it was Barney. Okay, so let's get that over with. Some of you are thinking it. This way we get it out of the way. So, raising money. Now do you doubt I'm a lawyer? There you go. We tell you what we're not going to do, and then we tell you what we're going to do. First thing is, and really this is the only thing. First of all, I do a lot of speaking for SCORE. I am not an employee of SCORE or in any way affiliated with them. So if anything that I say sounds like a great idea and you do it and it fails and you end up going bankrupt and your spouse divorces you and your kids don't want to talk to you again and the dog pees on your leg and you're living in a diaper box under the Brooklyn Bridge, you can't really sue anybody. Okay, it's just, it's just me talking. It's not SCORE. More importantly, even though I am a lawyer and I know some of you have legal and tax questions, I will try to answer them to the best of my ability later on this evening. There's a very big difference between giving out legal information and giving out legal advice. While I will be getting into some legal stuff in tonight's program, nothing that I say should be construed as one-on-one advice as to what you should specifically do in your situation. For that, I would have to meet with you, get to know you a little bit, maybe charge you a little bit of money, but I really can't do that in a program like this. So just be careful. Legal advice should only be given by a lawyer who is licensed to practice in your jurisdiction and knows what the heck he or she is talking about. So that's the important information. Okay, money makes the world go around. I got a book for somebody tonight, by the way. I'm going to give one of my books out tonight. Can anybody here tell me where that's from? Money makes the world go around. Quick. Anybody? You can speak. I'll let you speak. I'll let you shout out the answer.
It's a movie.
Which one?
Cabaret.
Cabaret, very good. And the movie and the Broadway musical. I'll give you the book after the program. See, this was the benefit to coming in late. You didn't think this was going to happen, right? There you go. Money makes the world go around. One of the songs from the Broadway musical Cabaret. One of the undercapitalization, running out of money, is one of the three biggest causes of small business failure in the United States today. There are three. One is the market isn't there and you thought it was there. The second is the market is there, but the competition is too fierce, you can't deal with it. And the third is running out of money, not having enough money to get through the first 6, 12, 18 months of operations while you build your cash flow and try to break even. Planning is the key to financial success. And let's face it, there is no such thing as a cost-free business. I am sorry. There are some people who think, and there are some people whose businesses don't require a lot of money to get started. Don't get me wrong, I'm not saying you have to spend tons of money, but all successful businesses require a certain amount of investment. There's a famous old Wall Street saying, I don't know, I tried to look it up online, I don't really know who started it, but it was something I learned as a young lawyer working on Wall Street back in the early 1980s. If you eat like a bird, you cannot excrete like an elephant. Now, the word excrete was not the word they used, okay? You can use your imagination here, okay? But it is absolutely true. If you're going to build a business that's going to cough up millions and millions of dollars, return on investment for your investors, that's not the kind of thing that happens with a $2 investment. Or in the immortal words of the rock singer Meatloaf, there ain't no Coupe de Ville hiding at the bottom of a Cracker Jack box. Okay, a certain amount of investment is necessary, especially if you're doing the kind of business that's going to generate millions of dollars in revenue and profits down the road. What are the steps in the capital raising process? Okay, well, everybody knows about angels and venture capitalists and banks, and I am going to talk about that stuff, but it really starts at a much earlier stage. The founders of the business, that's you. That's you and your business partners. Put in startup capital and you get what's called founders shares or founders equity. That's step one. Step two, you bring on additional founders and what we call sweat equity players. Sweat equity players are partners who don't contribute money to the business. They contribute their labor in the form of services. Sometimes key employees, consultants, maybe your lawyer or an accountant is willing to work for shares, although there's ethical rules, that prevent them from doing that sometimes. And there's special rules when you have tax rules that come into play when you have sweat equity players in your business. Some businesses do, some don't. Third, offering shares to friends and family, people who invest in your business not because they know what they are doing, but because they love you, which is an okay reason to invest in you, offering shares to angels. These are wealthy individuals. The town that I am speaking in right now is supposed to be full of them. I have heard that rumor. I do not know if it's true or not. Somebody sneezed, so it must be true. There are certain communities with a lot of wealthy millionaire next door types, and that's who you're looking for there. Venture capital rounds, and then last but not least, if you are extremely lucky, you get to do an initial public offering, an IPO, and become filthy rich and become a billionaire so you can actually afford to buy a house in this town as opposed to merely working here. Okay. So let's talk about when you first get started, when you're first launching your business for the first time. Okay. There are two places and only two where money comes from for a startup new business. And a lot of stuff has been written about this, and a lot of it's wrong. There's only two places. First of all, you get money from what they call revenue from your operations, what people pay for your goods and services. So if you start up a landscaping business and you start mowing people's lawns and they pay you every month or every week, however they do it, that money that comes in is called revenue, gross revenue. Okay, that's one place where money comes from. The second place that it comes from is capital from the founders. That's you and your partners. That's money that you and your partners put into the business out of your own personal pocket. And it includes things like credit cards that you run up, second mortgages, SBA loans. Let me tell you something about SBA loans. We'll talk about them in a minute. SBA loans are wonderful, but the one thing you always have to remember is that they are always second mortgage loans. A bank making an SBA loan to your business is always going to want a second or a third or a 10th mortgage on your family residence, on your personal home. That's the collateral they're really looking at here. They believe in your business, don't get me wrong, but it's the home collateral that they're really looking for. If you have no home equity at all, if you're totally maxed out on your mortgages, it's going to be hard to get an SBA loan for your business, although there are some exceptions to that. We'll talk about those when we get there. These are the only two places from your customers and from the founders. And there's kind of a tension between these two things, between these two sources of capital. Every business, when it starts out, doesn't have customers quite yet. It takes a while to generate revenue, to generate customers. During that period of time, the startup period, all the money that's needed to spend, you need to spend on stuff has to come from the owner's pockets in the form of capital. Okay, everybody with me so far? When you start a business at the very beginning, by definition, there's no revenue, there's no customers, so everything's got to come out of your pocket. Sooner or later, the customers come, they start paying for their stuff, revenue starts to happen, and you get to a point which we call breaking even. Or we call it the break-even point. Some of you have actually read about this. I mean, there is a mathematical formula for this, but let me just keep it very simple. Breaking even is when you're making enough money in revenue from your customers, from your operations, that you can pay all your bills every month without having to hit up your credit cards. That's layman's English for what we call breaking even. The business is self-sustaining. Now, you may not be paying yourself a salary as yet, but the revenue is at least covering the rent, the payroll, all the basic expenses that it has, the supplies, the equipment, whatever kind of expenses you have. The longer it takes to break even, the harder it is for owners to keep the business on life support. And this is just psychology. This is all it is. How many of you would start a business knowing that for the next 60 months, the next 5 years, you would have to hit up your credit cards for $2,000 a month to keep this thing on life support for the next 5 years? How many of you would do that? Well, the first year probably wouldn't be too bad. You'd probably get through that. The second year, okay. But if by the third year things aren't happening, at some point you're going to start asking yourself, and if you're not asking it, your spouse is going to ask you, why is it that you are doing this? Why are you putting this money into a business every month and nothing's coming out of it? Sooner or later, you lose heart, you lose faith, and you stop putting money in because you want to cut your losses. Okay, the longer it takes to break even, the harder it is for the owners to keep putting capital in that's going to keep the business on life support. Okay. Generally speaking, when I'm working with a startup business, I tell people you should be planning to break even 6, 12, or 18 months out. That's what your typical period should be. For different kinds of business. There are some businesses where you make money right off the bat. If you're a lawyer and you go off on your own, you hang your shingle, you get your first client, boom, you're already cash flow positive. You're already breaking even right there. There are some businesses, especially technology businesses, that have a very long lead time. It takes you sometimes 2 or 3 years to develop a software product, a media product, or something like that. So you're going to be going 2 to 3 years probably without seeing much revenue coming in at all. So you need to have a lot of startup capital for a business like that to get through that development period. Every business is a little bit different. Okay, I tell people that if you don't have enough capital to break even within 12, 18 months, you should consider partnering with a financial person, a deep pocket individual who will be able to fund and write the checks and hit up their credit cards and do all the stuff that you don't have the financial resources to do. If you don't have enough capital to get through the first 12 to 18 months and you cannot find a financial partner, seriously consider whether or not you want to do this. As a living. This is one of the ways you screen out a bad idea. There are lots of good ideas out there, but they have a very long lead time to break even. And those are not businesses that most of us in this room can handle. If you have the kind of financial resources where you can fund, a couple of $1 million, for the next 12 to 18 months out of your own savings and stuff like that, please call me after the program. Okay, that's all I can say. And do you have a daughter of marriageable age? Okay, that would be the second question. Okay, I'm only teasing, obviously, but that's, those are the kind of questions I'm going to ask. Here's where I'm going with this. The sooner it takes you to break even now. Now, obviously, the longer it takes you to break even, the harder it's going to be to keep the partners on board, to keep them motivated. The sooner it takes you to break even, the easier it will be to find lenders, investors, and other types of people. Success has 1,000 fathers, failure is an orphan. That's an old Chinese saying, I think. And it really is true in this world. Once people see that you have a bottle rocket on your hands, you're broken even, you're already giving your investors a return 6 months out, they're going to want to be a part of that. Hey, Cliff, you want to open up a new branch in Hong Kong? Great. I got somebody. This is where you can find the development money. I know a lot of investors. I work with a lot of investors who will gladly put money into a business to help it grow to the next level. What they don't want to do is pay the light bill. If you're not generating enough cash to pay the basic utilities, rent, all that kind of stuff, their attitude is going to be, hey, great idea, come back when you grow up a little bit, I may be interested. They'll do it in a nice way, but they're not going to want to fund the basic stuff. They expect that you and your partners have enough capital to be able to do that. Last but not least, this is just a term you'll hear a lot. It's called bootstrapping. Every once in a while, a business generates a lot of revenue, and the partners decide, hey, let's not bring in investors. Let's do it all. We'll starve for a couple of years, and we'll just put all of our revenue into growing this business. And that's called bootstrapping. That's what it's called. And if you have that kind of a business, God bless you. The sooner you can keep investors out of your company, the longer you can keep investors out of your company, the better. If you can fund everything with cash flow from operations, that is absolutely the way to go. Bootstrapping is the way to go. Investors, they can be difficult to deal with. We'll talk about that a little bit when we get onto this program. Investors are not always a good thing. Okay, I divide this program into 2 parts. Part 1 is what we call internal capital. This is money from the founders, the partners, the management, the sweat equity. Then in part 2, we talk about external capital, money from angels, venture capitals, banks, and other financial sources. I just find it easier to break this out into 2 parts. Right now, in the next half an hour or so, we're going to be talking about internal capital, the money that you and your partners put into the business. Okay. First of all, we have to make a very basic distinction here. There are 2 basic ways that you put money into a company, any kind of company. There's debt and there's equity. Okay, let's take this. This is very basic, but some of you guys may not know this, and it'll help you understand the future slides if we get to this. In a debt situation, somebody loans the money to the company and is repaid over time with interest. A lot of people think you can have a loan with 0% interest. That is not true. If you do that, the IRS imputes interest at what is called the AFR, which stands for applicable federal rate. This is the lowest legal rate of interest that you can charge on a loan. Right now, for a typical 3 to 5 year business loan, it would be about 2.5% per annum right about now. If you type in applicable federal rate online, you'll see there's a whole bunch of people, banks will have the latest calculations. You'll know exactly how much it is. You have to charge interest on a loan, or else the IRS imputes interest, and that's not a good thing. You don't want that. The loan must be repaid. Debt is a fixed investment. You have to pay the loan back, whatever the terms are. If it's a monthly payout, quarterly, annual, those payments must be made. If you do not make the payments, you are in default, and then that lender has rights. They can accelerate the loan. They can require you to pay it all. If it's a secured loan, they can seize all your assets and basically take control of the company. Debt is a serious thing. You know, most startups try to keep as much debt off the books as possible. Now, you can be flexible. Debt does not have to have a regular payment schedule. I do notes all the time where the payment is in 5 years in a single lump sum, principal and interest. And we'll talk about that. There's a special name for that, that when you're starting up a country. And that's okay. But at the end of 5 years, that payment must be made, or else bad things happen. Okay? If the company fails, if the company goes under, the people who hold debt, the lenders, get their money out before anyone else does. That's what debt is. When a company liquidates, the lenders are at the top of the tree. They get their money back with interest before anybody else gets anything. And that's why people lend money to companies, because they want to be in that position. Okay, the downside to holding debt is that the lenders do not have the right to manage the business. They cannot tell you what to do. They may offer their opinions, and they probably will, especially if it's your Uncle Ernie. He will definitely tell you, he'll have to have some things to say about how to run the business, but you don't have to listen to him. If all he's done is loan your money, if all he's done is loan money to you, as long as he's getting his money back with interest every month, year, whatever, he has nothing to say. You don't have to listen to him at all, except maybe at the Thanksgiving table. A lender has no upside if the company is successful. If the company takes off and becomes a bottle rocket and starts generating billions of dollars worth of revenue, all the lender is entitled to is their interest. That's all they get. You know, and that happens. I have seen companies that have taken off. The lenders say, "Hey, will you let me convert to equity?" Nope. Here's a check. Here's your principal. Here's your interest. Go away. Okay, that's the downside. That's when you're lending to a company. If the company goes south, you're at the top of the tree. If the company takes off, you really don't participate in that. That's the trade-off you make if you're going to loan money to a company. The other way you put money in is equity. Somebody makes a capital contribution to the company and receives a percentage of the startup. Keep in mind, you can only issue equity for 100% of a company, not more than that. Okay? Anybody here remember the movie The Producers, or the Broadway show? That's the gimmick, that's the scam that was going on in there, where he was selling 10,000% of the Broadway show. That was the game, the scam that he was playing. You cannot have more than 100% of a company outstanding. If you have more than that, it's illegal. You can't do that. Someone's going to sue you for fraud or something like that if that happens. Okay? Someone makes a capital contribution, they receive a percentage of the stock. If it's a corporation, it's called stock. In an LLC, it's called a membership interest, or just simply equity for an LLC, limited liability company. Dividend distributions are paid only in the discretion of management. There's no fixed payout with equity. If I make a capital contribution to your LLC, I have to sit and wait until you decide to pay me money on that, to give me a return on that. And I may have to wait years. Even though you have monthly board meetings, you are not obligated. Dividends are always optional and at the discretion of a board of directors. Unless, of course, if you're a big company, if you're a Fortune 100 company, then you have a regular dividend that's paid every month. But that's because the board decides that. There's a very large company that used to be here in Fairfield County. You all know the name. I won't mention it. That just decided, if you read yesterday's Wall Street Journal, to suspend its dividend after its fixed dividend after something like 120 years of delivering this dividend. So even big companies, have this. You are not required to pay dividends. It's always at the discretion of the board of directors. If the company has some extra money and they want to give their shareholders a little treat, they can do it, but otherwise it gets plowed back into operations. If the company fails, if the company heads south, equity holders get their money out after everyone else does. They're at the bottom of the pile. You know, when a company fails, when a company goes bankrupt, first the lenders get everything, and if there's anything left over, it's divided among the shareholders, okay, or the members of the LLC. If the company goes the other way, if the company takes off, this is where you want to be, is equity. The holders of equity are the ones who get rich. They have the right to manage the startup. The lenders do not, but the equity holders do, the stockholders do, and if the business takes off, they're the ones who get filthy rich because the stock grows in value as the company gets bigger and bigger, okay? Can be voting or non-voting, okay? It doesn't really matter. My point here is to understand the basic difference and the trade-offs between debt and equity. With debt, you're at the top of the pile if the company fails, but that's all. Your return is capped at the interest rate. With equity, you're at the bottom of the pile. If the company fails, you'll come away with nothing. But if the company takes off, you're the people who become billionaires. You're the next Mark Zuckerbergs, okay? Now, what about preferred stock? You've heard this thing. Preferred stock is kind of in between debt and equity. It's a separate class of equity stock, though. It is not debt. Preferred stock is not debt. Preferred stock is equity. If a company has preferred stock and you ask the question, who owns 100% of this company at this particular moment, you add up the holders of common stock and the holders of preferred stock. The total of those two are 100% of the shareholders. Preferred stockholders are shareholders, and they count toward the 100% of the shares that are outstanding. If the company fails, the holders of preferred stock get the money back before the common stock, but after debt. They're in the middle. So if a company with preferred stock goes under, the lenders get paid out first, the preferred stockholders get their money back with a certain guaranteed return, and if there's anything left over, the common stockholders share in whatever is left over. If the company takes off, though, the preferred stockholders can participate in that growth. It is equity. It's not, preferred stock is not debt, it's equity. They can participate. I mean, for many startup companies, you do what is called convertible preferred stock. So if the company really takes off, if you've got the next Facebook on your hands, you know, the holders of preferred stock can swap their preferred stock for common stock and grow with the company. And they can do that. So if you see, a lot of investors, angels, venture capitalists, like preferred stock because they can straddle the fence. If the company fails, they get out first. If the company takes off, they can pile in with the common shareholders and get rich along with them. It gives them the chance to see what happens. That's why if you're ever dealing with angels or venture capitalists, they probably will request preferred stock because they want that ability to be able to move either way depending on how the company does. Okay. Preferred stock in most states, certainly in New York and Connecticut, must be authorized in your certificate of incorporation if you are a corporation or in your operating agreement in your LLC. But it is a contract. You don't have to, there's no law that says that you have to offer preferred stockholders certain rights. It's negotiated. There's a bunch of rights that preferred stockholders can have, and you negotiate with your investor which ones they get and which ones they don't get. It's more of a contractual negotiation than common stock. Common stock, all the rights of common stockholders are determined by statute, by law. They have to have those rights. With preferred stockholders, you can negotiate it. They don't necessarily have to get all the rights that they can have. You cannot have preferred stock in an S corporation. Keep that in mind. One of the rules that S corporations are governed by is that they can only have one class of stock, common stock. You cannot have two classes of stock in an S corporation. It blows the S election, for those of you who know what that is. Unlike common stock, you negotiate the terms of preferred stock. So, for example, the stock can be voting or non-voting. It can have cumulative dividends. That means that dividends, even though dividends are within the discretion of the board, they can accrue over time, almost like an interest payment. They can also be, convertible stock can be convertible into common stock. Please hold your questions until the end. It can also be exchanged for debt. A preferred stockholder, you can structure preferred stock in such a way that people can move downwards into common stock or upwards into debt depending upon what the company does. You can absolutely do that. It's much more flexible than that. I mean, I have about 300 different forms of preferred stock instrument that I use for my clients, just to show you how many variables there are with this. So, Now you understand the basic tools, which is debt, equity, and preferred stock, which is kind of in the middle. Now let's talk about actually funding the company. Now you're putting money into the company for the first time, okay? Well, there are two ways. The founders, that's you and your partners, can either make loans to the company and be repaid with interest, or make capital contributions to the company and get what are called founders' shares, okay? The big difference between loans and capital contributions, especially for tax purposes, if you and your partners, let's say you have two partners, there's three of you, and you all want to put money into the company, but each one of you has different pockets. You know, two of you guys are pretty rich, but the third guy is not rich at all. He doesn't have any money, okay? If you're making loans to the company, you can do them any way you want. Each of you can put in whatever you can afford. There's no law that says that you have to put the loans in equally or based on a certain percentage. You can do loans whatever you want to do. If you're making capital contributions, however, under the tax laws, they must be what we call pro rata. Pro rata means based on the ownership percentages. So if Mo, Larry, and Curly want to set up a company, okay, and they want to put money in as a capital contribution and they're going to be equal partners, Mo must put in 33%, Larry must put in 33%, and Curly must put in 33%. There's no variation on that. If they're making loans to the company, however, Mo and Larry can put all the money in and Curly only has to put in $1. And it's okay, they can still be equal. If you make loans to the company, it does not change the ownership percentages. If you make capital contributions, however, it does. Whenever you make capital contributions to a company, it must be done based on the ownership percentage. If you do it any other way, it changes the ownership percentage. Okay, so if Mo, Larry, and Curly are equal partners and they put in a capital contribution, Mo and Larry put in more than Curly does, Curly gets diluted. He's no longer a 1/3 partner anymore. He's down to like 21, 22%, depending on how the arithmetic works and how much money he puts in. Okay? Whenever I'm working with a startup, inevitably I'm working with two people. One's got the money, the other has the talent. Okay? The talent person has no money, and the money person may or may not have talent. In a situation like that, I tell them to put their money in the form of loans. Why? Because then they can still be 50-50 if they want to be. That's the trick. If you do it with loans, it doesn't matter what the percentages are. You maintain your percentages no matter who puts in what. Okay? And the tool that we use for that, when I form corporations, I sometimes do it with as little as $10 worth of capital. I mean, you got to put some capital in. But it doesn't have to be $1,000. It can be $100. It can be $10. And then everything else we do with loans, which we do in the form of something called a grid promissory note, which I'll talk about in a minute. Okay, what is a grid note? Okay, a grid note is like a private revolving line of credit, like a credit card, but it's a private one. Basically, the founders lend money to the company up to a set amount. And then when they're not obligated to make the loans. Here's what the note looks like. I, Cliff Ennico, agreed to lend to the company up to $100,000 over the next 5 years in such amounts as I feel like from time to time. I'm not obligated to make the loans. I do it whenever I can. Okay, whenever the company needs money, if I can do it, I will make the loan, but if not, I will not. It's totally voluntary on my part. And then as I make each loan, the loan is noted on a grid, like a little spreadsheet, attached to the note. On thus and such a date, I made a loan of $100 to this company, with interest at 2.5% per annum. On thus and such a date, and I put my initials next to it. And each time I make a loan, I do that. And as payments are made, as the company pays me back, I record the payments on the grid. If you ever look at your credit card statement every month, that's a grid note. It's exactly right. You made a payment every month, and then you made all these charges, and you made another payment. That's exactly what a grid note looks like. It looks like a credit card statement or a checkbook statement. It's exactly what it is. It's a record of money going in and money coming out. You got to keep it up to date, people. Okay, if you're going to do a grid note, somebody's got to be disciplined enough to record those suckers on the note, because the company is entitled to rely on that grid. And if the grid is wrong, you could end up making loans that you'll never see back again. So make sure, if you're going to do this little grid note thing, make sure that you keep that grid up to date, as payments are made and as loans are made. Okay. Now, obviously, when the company has sufficient revenue, the loans will be repaid in the order made with interest, and those payments are recorded on the grid. Now, the one thing you have to know about a grid note: investors do not like them. Because it's debt, and remember, debt always gets out first if the company goes under. If you're asking me to make an investment in preferred stock for $500,000, I'm not going to like the idea that these grid notes are out there. I don't like the idea that if the company goes under, you're going to get your money out before I do. So what I'm going to suggest you do, I'm going to say, if you want my money, you should be converting those notes into equity. Swap them for stock, and then I'll make you the $500,000 preferred stock investment. So don't be surprised if investors ask for that. That's not illegal. They have every right to ask for that. This is only a temporary thing to get the company up and running off the ground. Once you start getting real investors, you're going to have to pay off these grid notes to the founders, to Mo, Larry, and Curly. Okay. Now let's talk about sweat equity for a minute. Okay. Sweat equity is basically somebody who's becoming a partner in the business. They're going to get a percentage in the company, so it's an equity investment. But instead of paying money, they put in their services. Okay. Now we live in a capitalist system, and in a capitalist system, money has value, but labor does not. And the theory that underpins that, it actually comes from a book that was written in 1820 by a famous economic philosopher, is that you always know the value of a dollar, but you don't know the value of somebody's labor. 5 workers doing exactly the same job at 5 different factories can be making all kinds of different money depending on their ability to bargain with the employer. All right, that's the theory. This is going back to 1820s. There are some people who think it's out of date. So if I'm putting in sweat equity, if I'm contributing my services to the company, technically I am making an equity contribution of 0 for tax purposes. Whereas the people putting in money are getting whatever they're putting in, if the company has no value, so we're talking about a naked startup that has a 0 value, sweat equity is not a problem. In my little example before, Mo, Larry, and Curly, where Curly doesn't have any money, Curly can put in his $5 and get 5% of the company. That's okay. He can afford that. Okay? It's not a problem. If the company, though, when the company grows and has value, sweat equity players get nailed. And they get nailed in a very bad way under the tax laws. Here's the best way to explain it. Let's say that I'm a landscaper, and let's say that you ask me to mow your lawn. I come over to your house, I mow your lawn, and you pay me $50. Okay, that's about right for this county. I think it's about right. Okay, you pay me the $50. You pay me cash. I have to report that on my tax return, and I have to pay taxes on it. So far, so good. You get that? Okay. Now let's say I come over to your house and I mow your lawn, but this time instead of paying me in cash, you give me a share of stock that is worth $50. The IRS treats that exactly the same as it does when you pay me in cash. I have to report $50, the fair market value of that share of stock, on my return, and I have to pay taxes on it. The one difference, of course, is that in the first case, you gave me cash, so I have cash money to pay the taxes with. In the second example, all I have is a share of stock, and the IRS does not accept stock in payment of taxes, if you've ever tried that. Okay, they don't like that. They want hard money. That's all they want. They want cash money. So unless I can sell that stock and get the $50 in cash, I got to come up with that tax out of my own pocket. We call that phantom income, is what we call. Phantom like a ghost is what we call that. That's a tax term. So if you have a company that's worth $100,000 and Cliff Enico is going to come in and do some work for you, and you're going to give me 5% of the company, I've got a $5,000 tax liability that I have to deal with somehow. And there's various ways that you manage that when you deal with that. If you have a corporation, there's really no way you can solve this problem. You can minimize the tax liability by issuing non-voting shares. Non-voting shares are always worth less than voting shares. They have lower value. You can give the employee options over a period of time with vesting over a period of years, and that lowers the liability and makes it more manageable, but you can never get rid of it completely when you have a corporation. With an LLC, okay, in an LLC, sweat equity players can be issued something called a profits interest. Now, this is getting kind of complicated. If you look the term up online, you'll see a lot of CPA firms have written articles about this. I don't want to get into the weeds too much here. The key here is that if you give me a profits interest, That profits interest is worth zero at the day I get it. It only has value if the company grows. What I'm getting is, when you give me a profits interest in an LLC, what I am getting is a right to the future profits of the company, not today's profits. That's what I'm doing. Those of you who know what a phantom stock plan is, it works a lot the same way as a phantom stock plan in a corporation. If you give me a straight out percentage interest in an LLC, today I got to pay taxes on it. But with a profits interest, I only pay taxes if the profits interest increases in value after I get it. It's a very good thing to do. Whenever I set up tech companies, I always make sure that the managers, the board of directors, can issue profits interests to sweat equity players. It's the most equitable way. And this is one of the reasons, by the way, if you're in a business where you're going to have a lot of sweat equity players, it's better to start as an LLC rather than as a corporation, because you can do this for your sweat equity players, whereas with a corporation you really cannot. There are other things you can do with a corporation, but they kind of go beyond today's topic. So you've started your business, you've assembled your founders, you got some money people, you got some talent people, you got some sweat equity players, but you've managed them in such a way that they're not going to get clobbered with taxes. Now we talk about raising outside capital from people who are not reporting to work and slaving away in the company every day. Okay? Up to now, your investors and your employees are the same people. All right? Everybody works in the company, everybody gets something out of it. Now we're dividing this. Now we're dividing the world into two classes, the worker bees and the money bees. Okay? You're bringing on outside capital. Okay, let's talk about friends and family offerings. First of all, there is nothing wrong with doing friends and family financings. A lot of people are nervous about doing it, but there really is no reason. Sometimes this is the only way you can get money. Okay? These are the dumbest investors on planet Earth. They really are. Oh, they're the wonderful people. But they can be real dumb because they're not putting money into this company because they think it's a great idea. In fact, many times people who put money into family members, their accountants and their lawyers do not like this very much. But they're doing it because they love you and they want you to be happy. Right? So that's why they do this, okay? My rule of thumb always, whenever you're doing any kind of a friends and family type of financing, don't treat them like friends and family. Treat them like total strangers. Seriously. Get the same paperwork that you would do if it was somebody like me making the investment. Get exactly the same paperwork. When people get money from friends and family, they tend to be a little loosey-goosey about it. They tend to be very informal, and that can cause problems in a very big way, in a number of ways. So, for example, Uncle Ernie gives you some money. He gives you $10,000 to open up a flower shop, okay? Is that debt or equity? Is he loaning the money or is he making a capital contribution? We just learned the difference between those two things, right? Well, which is it? Answer, if there's no documentation, it can be any way you want. So if the business, fails, well, then Uncle Ernie is going to say, well, wait a minute, I loaned you that money. When are you going to pay it back? And how many jobs are you going to work to make those payments every month that I want? Okay? I mean, if Uncle Ernie's a real jerk, of course. I mean, we're talking about this. Obviously, if it truly is, a gift, that won't happen, but you can't count on that. Obviously, if the business takes off and you go, hey, Uncle Ernie, listen, the business is going great. Listen, here's $10,000. I'm even going to give you another $2,000 because I really appreciate that you loan me this money. Well, what do you mean a loan? Hold on a second. That was not a loan. That was for 10% of the company. I own 10% of this sucker. And by the way, where's my stock certificate? I've been bugging you about that. Again, if Uncle Ernie's a jerk, this is what's going to happen. He can play it any way he wishes if there's no documentation. And even if it's a gift, by the way, problems can happen. One of my very first clients, years ago this was, she just graduated college. She was starting up a small business, actually in the town next to this one. And she had an aunt who absolutely adored her. I mean, this was her favorite kid, right? And the aunt gave her $30,000 to start this business. And it was very clear she did not expect anything back from this. This was an absolute out-and-out naked gift to the niece. Okay? Problem, they did not document it in any way. Now, the aunt was terrific. She was great, but you know what happened? She died. And when she died, her estate got handled by an estate attorney who, by definition, even though he realized this was probably a debt, this is probably a gift, even though he knew that, An estate attorney is required by law to do everything he or she can to maximize the value of the estate. They have no choice. If they don't do it, they get sued for malpractice by the heirs, is what happens. So what did he do? He basically called up the niece and said, I'm sorry, but for purposes of doing the estate paperwork, we have to treat this as a loan. Now, we'll negotiate the payment period, but we cannot treat this as a gift. I see no evidence that this was ever a gift to you. Even though it was quite clear from all, that Aunt Irma clearly intended this to be a gift, if you don't get proper paperwork, that kind of stuff can happen, okay? If someone gives you money, it's okay for them to give you money, but get it in writing. It's called a deed of gift. It's a little, like a one-paragraph document. It won't cost you anything at all to have an attorney do this for you, okay? Get this. You can find even forms online that are pretty good for this kind of thing. It's called a deed of gift. Get it in writing, and watch out for gift taxes. If it's an amount over $11,000, you might have federal and state gift taxes. Make sure you have an accountant help you planning for that. There are taxes on taxable gifts. You should be aware of that. Some gifts are taxable, so be prepared of that. Not income tax, but gift taxes, federal gift taxes. Another problem with friends and family, although they're usually wonderful people, they may feel their investment entitles them to make demands upon your company. They may not care about the money so much, but, Thanksgiving's coming up, right? Don't you dread Thanksgiving dinner? You will dread it much worse if your relatives are investing in your company. Thanksgiving becomes the worst day of the year. Because what will happen is, after dinner, when the tryptophans are starting to kick in, they pull you out into the corridor and they say, "Hey, Cliff, you probably know about Uncle Joe, about Cousin Ernie. He's going through some tough times right now. He's just going through his third divorce, and one of his kids just got is in prison right now, and he's having some tough times here. Can you find any place in your organization for Cousin Ernie? Let me ask you this: just given what I've just told you, do you want to hire Cousin Ernie?" No, you want Cousin Ernie as far away from your company as possible. But if this is your biggest investor, if this is Uncle Joe, Cousin Ernie's father, asking for this, what are you going to do? You're probably going to have to do something here, because this is your biggest investor, don't forget. You can't just ignore them. Don't get me wrong, Uncle Joe has no ability to manage your business, but in a situation like this, he does have a little bit of leverage, doesn't he? If he's your biggest lender. He could pull that loan tomorrow and you're sunk. So you're going to have to find a way to deal with the whole Cousin Ernie thing, okay? Seriously, this happens in families. Also, too, keep in mind, I do have some clients with very large families. Keep in mind that if more than 5-10 family members make investments, you may have to file a document with your state securities regulator. Every state in the union has what they call a de minimis amount, where if you do an offering and fewer than X people participate, you don't have to do anything. But the minute you go over the X, you have to file a document with it's called a disclosure document, with the state security, not with the SEC in Washington, but with the state security as regular. In the state of Connecticut, where I am right now, it's the Department of Banking in Hartford, where you would file this document. And that can cost you a couple of $1,000s to do. And I will tell you, in Connecticut, the number is 10. Okay, but in some states, like Texas, it's 3, by the way. So if you have a lot of family members in Texas, rich oil people that you want to invest in your company, talk to a good lawyer before you do that, because you may have legal requirements that you have to do if you go over that what they call the de minimis number of investors. Okay. Make sure you get the same documentation from friends and family you would get from what we call an arm's length investor, somebody like me, a total stranger. You need a subscription agreement with something called an accredited investor questionnaire. That means that they're rich enough that they don't have to worry about this. They're not relying on this investment for their retirement. There's certain language that has to be in there. Make sure they sign a shareholders agreement if you're a corporation, or an operating agreement if you're an LLC. If it's debt, you do a promissory note. If it's equity, you do a stock certificate, or an LLC is called a membership certificate. You don't have to do it for an LLC, one of these, but it's a good idea to do. It's a very easy form. Attorneys don't charge a lot for doing these. Consider the convertible promissory note. A convertible promissory note is a note, it's debt, but it can be converted into non-voting equity by the family member at any time. Rule number 1, your investors get voting shares or voting equity in your company. Your employees get non-voting equity. People, if you give an investor voting rights, that means that you must give them notice every time there's a meeting of the directors and shareholders. You must get their vote or get a piece of paper saying that they waive their right to vote. These people have rights that non-voting shareholders don't have. Most people who are investing, who are sweat equity players, are not really looking to have the right to manage the company or the right to vote. They just want the money. They want the economic interest in the company, the improvement in the value, and that you can give them. Non-voting shares allows them a piece of the profits of the company going forward. What it does not give them is the right to manage the company. That's a very basic rule of thumb. You only want people to have voting rights that are your partners. You're in the full legal sense of that term. Okay? Anybody who's not going to be working 95 hours a week in the company every day should not be getting voting shares, at least when you're first starting out. Consider the convertible note. It can be converted by the family member at any time. It also can be converted by you if the family member becomes a nudge or a time vampire. These are not legal terms. Okay? But if you do bring on a family investor and they just turn out to be impossible, you can always pay them off and get rid of them. That's the beautiful thing about this. You want to make sure that you have the right to pay the note off if somebody is just becoming trouble. Also, too, keep in mind your investors down the road. Your real investors may want you to get rid of those notes. So you got to have the right to convert them into equities to make your other investors happy. Otherwise, if you have to go back to Uncle Joe and get his permission to convert the note, that could hold up a $5 million investment. And I have seen that happen, where somebody's going to put $5 million into a company, but they say, you got some family loans out there, get rid of them, and the loans are drafted in such a way that Uncle Joe has to approve the decision. And Uncle Joe's in a nursing home, drooling in his porridge. Okay, he's not in a position where he can make those kinds of decisions. I've seen those kind of things happen. Okay, I mean, being a lawyer, you see the worst of it. That's why people hate us. Let's face it, you hate lawyers all the time. You hate them. And why? Because we're always looking at the worst cases. That's because that's all we see. When good things happen, people do not call their lawyers, ladies and gentlemen, when they are having a nice day. This does not happen anywhere in the world that I am aware of. When people call their lawyer, it's because bad stuff's happening or has already happened. Most of the time it's already happened. That's when they call their lawyers, when it's too late. Okay? That's why we're in a world where all we see is the bad stuff. So this is why we're that. This is why we are that way. You know, if you're a kidney doctor, all you see is kidneys. That's all you see. You don't see any other body parts. We're the same way. Last but not least, consider the grid note. The grid note I like the grid note. It's very simple. It's only a couple of pages long. It enables the family member to make small contributions over a period of time, or he can also charge expenses to his credit card if the company allows him to do that. And he can put those charges on the grid note and get reimbursed by the company. It just enables a way to make that very flexible. I like the grid note. It's a very useful tool, and it's not that expensive at all to get one of those. Okay. Now let's talk about the next step, angels and venture capital. Angels are wealthy individuals who provide usually $100,000 to $500,000 in capital, not more than that usually. You could have an angel investment of $1 million, but it's a very rare thing. I've only seen it once or twice in my entire 38 career. You know, this is it. You don't go to an angel for $5 million in capital. You do for $250,000 to $500,000 or less. The things you have to watch out for with angels. Sometimes they have hidden agendas. They may have reasons for investing in you that don't have anything to do with your business or anything like that. So, for example, let's say that you happen to bump into a Hollywood celebrity at a party. That has never happened to me in my life, but let's just say it happens. Okay, and this person is interested in your business and they're going to make an investment. What's in it for them? I mean, this is somebody making $30 million, you know, a movie, and they're going to put $100,000 into your startup. Why are they doing that? Is it because they see you as the next Facebook? Well, maybe, possibly. But I think what they really want is publicity here. They want to be seen as being, you know, a savvy investor who invests in startups, right? Let's face it, when we think of most Hollywood actors, what do we think of in terms of their IQ level? Let's be very honest. Do we think they have the typical Hollywood actor has a very high IQ? Do we? Really? We don't. It's a prejudice, of course. Some of them probably do, right? But we don't think of it that way. So if I'm a Hollywood actor, especially one who is not noted for, you know, his investment savvy or his business knowledge, doing something like this gets me a lot of positive publicity. By the way, always look out for celebrity investors. Always. They almost always have a hidden agenda, and you got to find out what that is. You may be okay with it, but you got to find out what that is. You know, there's another reason why they are doing what they are doing. The other problem with angels is, again, they're not able to put in $5-10 million. The investor who can make it, there are a lot of people out there, in fact, especially in this county where I am right now, there are a lot of investors who can make $100,000, $200,000, $300,000 investment, but they can't do $1 million, $2 million, or $5 million. As your business grows, you need to move on to the next level of investor, people who can do $1 million or more investment. And you don't want the angels in a position where they can block that. Angel investors are notorious for asking for something called a preemptive right. That's a legal term. It means that if you ever do a subsequent round of financing for a lot more money, they get to buy shares at that price to maintain their percentage ownership. Always, when an angel requests that, fight it, fight it, fight it. Do anything you can to try to get that provision out, because that will kill future investment. Big players, big investment players do not like other holders having preemptive rights, because it changes the percentages. They're putting in $5 million for 25% of the company, but if the earlier investors exercise their rights, that then goes down to 20% of the company. So you see how this works? You have to be very careful. Look out. The word preemptive right is a dirty word when you are dealing with angels. Just know that, okay? Now we move on to venture capitalists. Now, these are professional investors. Most of them are companies. They're investment firms who invest $1 million and up. Okay, the thing you need to know about venture capitalists, about VCs, they are not long-term investors. They are not investing for 100 years here while you build a family legacy. They want to see their money back in 3 to 7 years. Right now, it used to be 3 to 5 years, but now, given where the economy is and everything, you might get somebody willing to hang out for 7 years. And they are going to be on your back constantly. You know, every time you do an investor call, every time you have a board meeting, they're going to be all over you. How you doing? How you doing? Where's our money? When are we going to get our money? When are we going to do this? I mean, this is all they care about. And usually they want what's like a 20% internal rate of return. That's like a 20% interest rate every year. Okay, that's what they want. They want to see a significant return. If it's not happening, they get nervous. Okay, and they will be tempted to sell you out. Most often, VCs get preferred stock, and they're issued in rounds. Series A, B, and C. This is, by the way, a very good little website that explains. It's one of the few websites that I've ever found that accurately describes the difference between a Series A, a Series B, and a Series C offering. So you may want to take a picture of this. It's from a website called startupfreak.com, which I have no interest in, just so you know. This is not my aunt who's running this thing. I got to make a disclosure, okay, when I do something like this. But it's a very useful thing that explains what Series A, B, and C rounds are. You do them at different times and for different purposes. I won't get into it here because it kind of goes beyond what we're trying to do today. Just remember the golden rule. Now, you all learned the golden rule when you were a kid in Sunday school, right? Or whatever religious tradition you come from. Well, there's a different golden rule in this world, and that is, she who has the gold makes the rules. And if you're ever dealing with VCs, you will see exactly what that means. You're going to send them your term sheet, and they're going to come back at you with like 50 things they want in your documents. They're going to totally rewrite the way you run your company. But if you want $5-10 million from a VC, that's what it's going to take. Last but not least, initial public offering, IPO. Okay, this is the holy grail, obviously. I mean, the companies that do this, they're on page 1 of the Wall Street Journal. Okay. This is the dream that every entrepreneur hopes for, where you sell your shares to the public, and now you're a publicly owned entity. You're listed on the New York Stock Exchange, and everybody knows who you are. Okay, it's a very complicated process. You must register the offering with the SEC and state securities regulators. Almost all of the states here have their own securities regulators. They're called blue sky officials, is what they're called. In Connecticut, here is the Department of Banking in Hartford. Just getting cleared by the SEC is not enough. You also have to get cleared by the state securities regulators, depending on the type of IPO you're doing. A very expensive process. A typical IPO costs anywhere from $50,000 to $100,000 in legal and accounting fees alone. Just so you know, this is not for the faint of heart. You have to prepare a prospectus. That's a detailed business plan. It has to look a certain way. Virtually every section is dictated by law, what you have to say in there. And you have to give it to every prospective investor in the offering. No exceptions. Okay, the IPO process is obviously prohibitively expensive, but there are alternatives. You can do what are called private placements to equity and to accredited investors. These are accredited investors are extremely rich people who don't need the protection of the securities laws. So if you make an offering of your securities only to filthy rich people, to millionaires and billionaires and gazillionaires, and they're the only ones who are allowed to come in, and there's only a limited number of them, that's called a private placement. You don't have to go through the IPO process for that. There's also something called equity crowdfunding, which you are probably wondering, what is that? Well, here's my slide. Okay, this is something very new. In 2012, the world of investing changed in a very dramatic way. Then President Obama signed the JOBS Act. It stands for something our business startups or something like that. It basically liberalized a lot of the securities laws in the United States that have been in place since the 1930s. It's probably the biggest change in securities law in almost 100 years. Basically, there are several titles to the statute, but the one that's most important for you guys is Title III of the JOBS Act. It's called JumpStart Our Business Startups Act. I finally remembered the word. JumpStart Our Business Startups Act. And of course, when the SEC, when Congress gives something an acronym like that, that's not an accident, folks. There's a reason why they do it that way. This is a Jobs Creation Act, and that's what they want it to be. Under Title III of the Jobs Act, for the first time, companies can raise money on crowdfunding portals like Kickstarter, Indiegogo. You know what a crowdfunding portal is, okay? Basically, what you do is you prepare a disclosure document, which is actually a very informal document. It's actually a Q&A. You go on the SEC site and you fill in 50 answers to 50 questions. And that is your disclosure document. That gets posted on the portal. Investors can look at it, and they invest in you just like a crowdfunded offering. You know, you say, we're looking to raise, $500,000. Here's what we're going to do with the money. And then people invest, and if you happen to hit 500,000, then boom, ka-ching, you get the money, and they now own a piece of your company. Just as would be the case with an IPO, although at a fraction of the cost, okay? However, what Congress gives with one hand, they tend to take away with another, okay? Basically, when you do this, first of all, you cannot advertise and promote the offering yourself. All communication with investors must take place through the portal. So, for example, you can certainly send a notice. They actually have a form of this. The SEC has a form of this, which you can send to investors saying, hey, we're launching a crowdfunding campaign. Go to our portal at thus and such an address and see what we're all about and see our disclosure documents. But that's all you can do. You cannot put anything on your website to promote the offering. Everything has got to go through the portal because the idea is they want all the investors seeing all the information at the same time. Is what they want to see happening here. That's rule number one. You can raise up to $1 million over a rolling period of 12 months. And also there are restrictions on how much investors can invest. So, for example, for investors who are not accredited investors, you're limited to $2,000 or $5,000 if you meet certain thresholds. Now, the portal will take care of a lot of that for you. They will vet the investors. They'll make sure that these people qualify to invest in the offering. That's why you pay them, and you will pay them a pretty good fee. The typical fee that I'm seeing right now with the crowdfunding portals that have been set up is about 10 to 15% of the offering amount. Just so you know, that's how much they're going to charge. But believe me, they earn it. They're the ones responsible for making sure you don't bring on any bad investors, that you don't violate the securities laws and all this kind of stuff. It is tricky. However, I will tell you that right now, as I'm speaking, about 250 companies have done these. Interestingly enough, liquor is a very common theme in these companies. A lot of craft breweries, a lot of like single barrel distillers, and those kind of people. Food, liquor, entertainment. That guy from The Producers, if he was doing an off-Broadway show today, he'd be doing it as a crowdfunding, just about. Let's face it, wouldn't it be great to say that you had a piece of Hamilton, the hit Broadway show? Wouldn't you want to have a piece of that? You know, I actually wrote, in my book, I actually write about this. Crowdfunding is ideal for B2C companies. I'm not seeing a lot of B2B being done with crowdfunding that have a compelling product, service, or story. I call them wowie-zowie companies. Now, that's not a legal term. If you're going to do a crowdfunding, you want to get buzz. You want people saying, wow, did you see this? There's this company. They got this new thing for self-driving cars right now. It's going to help them like go backwards and do somersaults, and people, it'll be like trick cars and stuff. Like, you got to take a look at this, man. This is really sick. That's what you want, is to generate the buzz. A company that may have a great product and a great technology, but if it can't generate that kind of buzz, that kind of excitement, the Title III crowdfunding is probably not going to work for them. Title III is really meant for companies who have a compelling story, that are trying to do something that's very compelling, that's very different. If you can't tell your story in 10 words or less, Title III crowdfunding is probably not going to be for you. One of the reasons why liquor companies, I think, are doing a lot of this, like craft breweries, they have a very strong local following already on social media that are taps for potential investors. The thing about Title III is you don't want to do a Title III crowdfunded offering if you only have 5 Facebook friends. The companies that do well with crowdfunding are the companies that have thousands, tens of thousands of social media likes and participants that they can then solicit to become investors in the offering. And to do that, you have to have a following. People have to have a reason for investing in your company. That's why I think the liquor companies, craft breweries, generate very loyal constituents, very loyal customers. If you are a fan of a local craft brewery, it's almost a political thing with you. You want to support this company. And the investors are very excited, they're very emotional, and they're very motivated. This is probably why I'm seeing so many of these companies doing these offerings, because they already have the built-in fan base that they can convert into investor base. Keep in mind that if you raise the target amount, if your offering is successful, these people become your partners. And you must treat them the same as you would a regular investor. The only problem is there's 2,000 of them who invested. You're going to have to, investor relations is going to be something you're going to have to learn about if you do a crowdfunded offering. You're going to have to communicate with them regularly. They're going to be calling you. They're going to be sending you emails every hour, every minute. Keep in mind, these are not professional investors. These are not VCs. This is mom and pop, who've never invested in a company before, but now they're investing in your brewery and they're worried they're going to lose the $200 that they invested in your company. And they're going to be sending you emails. How's it going? What's your latest brew? What are you planning on doing? And they sound like Wall Street advisors. It sounds like Wall Street journalists. It's actually hard. I had a client who just did one of these recently, and they have one employee who does nothing but answer investor emails 10 hours a day. That's all this person does. For a startup company, that's a big investment of time and money. It's not for everybody, but for the right kind of company, it can be a great way to raise money. And I happen to have, I'm proud to say this, the very first book in the marketplace on how to do one of these. It's called The Crowdfunding Handbook, and it'll cost you all of $25, okay? Wherever books are sold. I'm very proud of that. So that's what the cover looks like, okay, which I'm very proud of. And this is me. Okay, I deliberately kept this program a little short because I realize I think most of you have questions about specific stuff, but I want you to see how it all fits together. This is how the capital raising process works for the typical startup company. It begins with you and your partners, and you work out to the sophisticated investors and maybe a crowdfunding if you are the right kind of a company, if you're a wowie-zowie company who can take advantage of that. So without any further ado, that's all I have to say. Let's open the floor to questions and answers. Sir, you've been dying to ask a question.
2 questions. First of all, does anybody do an S corporation anymore in your experience? And number 2, if your product is geared toward commercial enterprises, corporations, have you seen situations in which the entrepreneur has gone to those potential customers for funding in lieu of crowdfunding?
Okay, 2 questions. First of all, are people doing S corporations anymore? The answer is absolutely yes. In fact, more and more I'm seeing LLCs elect to be taxed as if they were an S corporation. And the reason for that is when you reach a certain size, okay, there's a little trick you can do with S corporations where you, the owners, can divide your income between salary and distribution of profit. You can't really do that with a C Corp, but with an S Corp you can definitely do this. And it reduces your FICA, your FUTA, and your Medicare tax. Usually, I can't really generalize it. It depends on the type of business you're in, but if you are making more than $100,000 a year in net income in your company, you probably should talk to your accountant about converting your LLC into an S Corp, because there are certain tax advantages that are associated with that. Frankly, I expect that to increase if the new tax bill passes. Right now, Congress is offering a lower tax rate on S corporations that are engaged in certain businesses. If you are in that category, and if the bill passes, of course, this hasn't happened yet, I think I'm going to be seeing a lot of companies converting from LLCs to S corps. I'm going to be seeing a lot of that happening. Now, the second question about, have you ever seen companies go to their customers? Well, yes, of course. I mean, that's what a crowdfunded offering is. I mean, basically, but it doesn't have to be a crowdfunded offering. I mean, if you have a key customer, who's invested in your business, you can certainly, try to make them investor. Keep in mind, though, remember what I said about the hidden agenda? They are also, I'm a little against just personally mixing those relationships. Once a customer becomes an investor, they expect special treatment. They want things like most favored nation clauses, where they get the best prices of anybody, that you deal with and stuff like that. There's some downsides to it. But however, look, you get your money from wherever you can. The best place to raise money is from people who are already, to some extent, invested in you. Your customers, your fans, your people on social media. That's what the crowdfunding thing is all about. These people have already bought your company to a certain extent. Now you're just asking them to make it official and put their money where their mouth is. But by all means, nothing illegal, immoral, or fattening about it, but be aware that if you're getting money from a customer or a supplier, you got to try to work hard to keep those relationships separate. Or else, they will get confused, and that's going to cause problems for you. Sir?
In your opinion, what level of risk is associated with crowdfunding in the idea that you may lose competitive advantage by putting your idea out there?
That's a good question.
Level, and then you've now knocked out investors, you actually have competition by someone who's just fishing these websites for ideas.
Yeah, it's a very good question. I actually have a whole chapter in my book about the different kinds of people who are going to be investing in your company. And this is a major concern right now. It's one of the reasons why a lot of people are saying that crowdfunding is never going to take off. And especially a lot of investment advisors are saying this, because they're saying, especially if it's a company that's going to qualify at some point for real venture capital, what they're saying is, look, if you do one of these, you're going to be bringing 5,000 people on board. The VCs are not going to look at you. They're not going to take you seriously. They're going to want you to pay those people off and get rid of them. And they're right. That's why we're not seeing a lot of tech companies, I'll be honest with you. We're not seeing a lot of tech companies doing the Title III crowdfunding. A lot of them are doing, there's another type of crowdfunding called Title IV, which is very different, for much larger sums of money, mezzanine financing type money, 10, 20 million. And that's very popular, but the lower level, no, and that's exactly right. That's why it's companies like craft breweries, a lot of retail and service businesses that cannot qualify for traditional venture capital are looking at crowdfunding right now, because they can't get money. If you have a restaurant, a very popular restaurant, you have 50,000 customers, and you've got 25,000 Facebook likes and 30,000 Twitter followers. If you want to go out and raise money, you got to get a bank loan. VCs do not invest in restaurants. They just simply don't. It's a service business. They don't do it. Right? If you want to raise serious money, though, crowdfunding would be a great way for a business like that to raise money, because the VC money is not there. If the VC money is there, then I think most investment advisors would say don't do a crowdfunding for exactly the reasons you say. It's going to be, it's going to show the world that you're not ready for prime time yet, that you made this horrible decision. By the way, one of the pieces of advice I give in my book is that if you're going to do a crowdfunding, always make sure the shares are redeemable, that you can buy them back at some point with a fixed return on investment, because that way, if you do get into a situation where a real investor comes down the road, you have a mechanism where you can pay those people off and reduce your shareholders to a manageable number. Also keep in mind, you can't really do this with an S corporation. S corporations right now can only have up to 500 shareholders. An S corporation could theoretically do a crowdfunding, but if you're at all successful, you're going to hit that threshold pretty quickly. So S corporations really can't do them. Yes?
Thank you. Wonderful presentation. When I see quite a number of startups, entrepreneurs, but their opportunity essentially is a project. It's a venture for a project. It's not, could you use this grid method to help?
Okay. The question is, and it's a really good one too, it's what's the difference between a project and a company? And believe it or not, that's a very philosophical question right now. And you're touching a nerve here. It used to be, up until 2012, up until Title III passed, that if you were doing crowdfunding, you were doing what was called project crowdfunding. You weren't asking someone to invest in a company. You were asking them to contribute to a project. So, for example, I have a friend who's an inventor who came up with a new type of, you know what a spork is? It's like a combination of a fork and a spoon. You use it for salads, right? He came up with a new kind of spork, a really cool design, and he did a crowdfunding, and he actually raised about $40,000 for him to get his patent, to find a buyer. He ended up selling it to one of the major, companies that make, gourmet, food, kitchen utensils and stuff like that. He did a beautiful job, but all the investor got was one of the sporks. When the thing came out, he got an actual spork. He didn't get a return on the investment. He just got a free spork. He got a free spork, for his investment. It wasn't free. That's called project crowdfunding. Have you been reading about these initial coin offerings, the Bitcoin offerings? Okay. This issue has come about in a very big way because what the Bitcoin people are saying is, look, this is not an investment in a company. When we issue these tokens, these Bitcoin, Ethereum tokens, those are just tokens. They represent your investment and they may increase in value, but you don't have a piece of our company, you don't have a percentage in the future profits and everything like that. And the securities regulators, at least in the US and the UK so far, are saying, we're not buying that. I mean, the shares, the Bitcoins are going to move up and down depending on how the value of the company goes. That's a share. That's a security. And I think that's going to be, you're going to see some case, you're going to see some law cases, some litigation on this actual topic because it's a very big debate right now.
I'm talking about very traditional.
Yeah.
People has prospect for a good project, but the person has the talent and doesn't have the financial.
Yeah. Oh, yeah.
Can we use your...
Oh, sure. Well, no, okay. If you're doing Title III, you are offering a share of your company. If you're asking somebody to invest in a project that's not an actual company, that's what Kickstarter and Indiegogo have been doing since the early 2000s, is that kind of crowdfunding. And it doesn't have to be a business. There was a famous one that was done a few years ago. A couple was having trouble conceiving. So what they did was they did a crowdfunding for their in vitro fertilization process. And the deal was that if they raised the money and they did conceive, the investors would get to name the kid. They would actually put a list up of boys' names and girls' names, and the investors would decide what the name of the child would be. I thought that was so cool and perfectly legal. I mean, you can do that. That's okay, Of course, you have to live with that, okay? People come up with crazy names for their kids sometimes. You got to be careful. Do you really want your child named by a committee? I really want to think about that. I would think hard and long before. But you can do stuff like that. And you're not bound by the... What I'm talking about here, this Title III crowdfunding, is governed by the securities laws. You've got to do it a very special way, and there's all kinds of rules and regulations, and it may not be worth it. If you have a project, the only thing about project crowdfunding, you have to be very clear what the investor is getting in exchange for the investment. Because if there's any loosey-goosey language in there, it's going to lead to legal trouble. And there have been cases where investors have brought class actions against crowdfunded offering sponsors because it wasn't clear exactly what they were getting. They thought they were going to get a return on their investment, but all they got was a free plastic toy. Okay, if that's the case, great, but you got to be very specific, saying you may not get a return on your investment if we launch the invention, if we can't get it manufactured in China or elsewhere, and we're successful, you will get one of the first 500 units. Be very clear about that. If you're at all hazy about it, it's going to create problems because again, investors, will restructure the deal in their minds depending on how the deal goes. And that's, I said that about friends and family, but it's really true about all investors, too. They're all going to do that. Ma'am, is there a question over here? I saw a hand.
Oh, I was just going to ask if you did name the baby.
Oh, I have no idea how it came out, by the way. So I really should have followed up on that before I use an example like that. I apologize. Yes?
I have a question about, so in case of crowdfunding, or also when you do like the greed, how do you determine? So the percentage of ownership is just a function of the dollar amount that was invested?
Okay, this is a very good question. Okay, generally speaking, when you do any kind of an offering, you're putting a value on your company. And how can I say it? If you are really good and sharp about this, you'll actually have a professional valuation done, which costs somewhere between $10,000 and $20,000. But it's from an independent firm, and a lot of investors like to rely on that. But a lot of people don't have that kind of money to spend. So what they do is they simply say, we're raising we're raising $1 million for 20% of our company. Now, if you do that, you have put a valuation of $5 million on your company. It doesn't have to make sense. if the investors buy into that, it's perfectly legal to do it that way. You do not have to have an independent justification of your valuation. You can set the valuation at whatever you think the market will bear. You may recall a couple of years ago, Facebook bought that company WhatsApp. Remember that, the app developer? They paid over $2 billion for a company that had no profits, no revenue, and was over $2 million in debt to its founders. Tell me, what multiple of earnings did Facebook use to decide what the value of that company was? It's math that doesn't exist, basically. You can set the valuation at whatever you wish. Just keep in mind that if you do an offering and if it's successful, that then becomes the benchmark for future offerings. And one of the things you try to avoid, especially when you're dealing with venture capital, is something called the down round. A down round is where you do an offering for $5 million, you get money, you try to do an offering at $10 million, it doesn't work out, so you reduce the offering to a $3 million valuation, and now new investors are paying less than the old investors did for their shares. That creates problems and that creates lawsuits. So if you're planning an investment, get yourself a good financial advisor. A lot of accountants are very good at this, by the way. You don't have to hire an investment banker. You can get an accountant to help you with this, to figure out what the appropriate valuation would be. Because if you're too conservative, you're cheating yourself. But if you're too generous, it may be harder to raise more than that in the next offering, and then you're going to have to go back and tell your investors that you're having a down round, and they will not like that. They do not. That's one of the worst news you can give investors, is that you're doing a down round and new investors are going to be coming in for less than what they paid. They do not take kindly to that, and they won't. Yes?
What is in the case of a very, like angel investors, of a very young, recent company, how do you determine that value? What goes into the evaluation?
Okay, well, whole books have been written. The question is, how do you determine the value of a startup company? And it's one of the most difficult questions that you have, because it used to be, back 100 years ago, when everything was manufacturing, there wasn't anything such as high technology back then. It was easy to value companies. You look at the earnings, you look at the profits, you look at the revenues, and there was certain math that you could do that would project what these things would be going forward. But for today's startup company, you have a startup company with an idea, a product. It's under development. It hasn't been patented yet. We don't know what the market potential is. I mean, it looks really cool on paper, but that's all. How do you value that? The only way that you can do it is to value the intellectual property, and the way they usually do it is by predicting what its future revenue potential is going to be. Well, what is the future revenue potential of a company that's making steering wheels for driverless cars? I haven't a clue, really. Seriously, I have friends who do valuation. What they do is they look a lot at what they call comparables. They look at a lot of other deals, and then they try to figure out, they use statistical methods to figure out what a reasonable valuation would be that falls in the middle. So, for example, if I did have that software startup, I would look at other offerings of companies that were doing driverless car technology. I would plot it on a graph, and I would figure out what the median is. If you know anything about basic statistics, I would try to figure out at what point does this company fit in that overall scheme of things. That's probably what Facebook did when they bought WhatsApp. That's probably what they did. I don't know, but that's probably what they did. It's the only way you can do it. There's just no math. I mean, a company that's $2 million in debt, no revenue, no profits. It's the imaginary numbers you're talking about there. This is math I did not learn in high school or college. So anyway, it's one of the hardest things to do, and it all depends on how much buzz you can generate. It all depends on how much valuation. I mean, obviously, Facebook was able to get WhatsApp to agree to that valuation. I mean, let's put it this way. I mean, would you turn down $2 billion from Facebook? I don't think you would. I mean, the company only had 12 employees, by the way. You realize how rich those guys are now? Seriously. I mean, somebody offers you a deal like that, you take it. I mean, forgive me. I don't care who you are. You're going to take it. It's a good question, though. And this is what makes it so hard right now. Valuation is one of the hardest things in the world to do. And unfortunately, there have been some recent changes in tax law now that require companies, especially companies that are doing option plans for their employees, to actually have an independent valuation done each year. And while that's a good thing for the valuation community, that's going to be a bad thing for startups, because an independent valuation, if you've ever had one done, it costs between $10,000 and $20,000 to do it the right way. And to do that every year for a startup company that's living off the founder's credit cards, I just don't know how they're going to do that. I'll be very honest with you. I'm not a big fan of. I understand why they're there. They want to protect investors. They want to have some reality to valuations. I totally get what they're trying to accomplish there, but they're doing it at the expense of making it possible for companies to raise capital. So, any other questions? Boy, you guys are good. Did I really cover the waterfront that well? Okay, sir.
You didn't mention private equity per se. You did talk about private placement, but could you say a few words about private?
Could I say a few words about private equity? Don't do it. I'm only kidding. Private equity is generally not at this stage of the capital raising process. Private equity is usually for a company that's more in the mature stage of its life cycle, that is public, but that wants to get rid of its public shareholders and go back to being private. Again, we used to call these deals, what did we used to call them? We used to call them stock buybacks or stock redemptions, we used to call them, where an investor will come in and take out the public shareholder. Keep in mind, an IPO is a mixed bag. Yes, your stock is publicly traded, you have all this public money coming in, but you also have all the SEC rules that apply to public companies. And those can be onerous after a while. That's why companies are under such pressure to report their earnings every quarter and stuff like that. There's only one company that I know of that has been able to go public and continue operating as if it were an entrepreneurial company. Without having to pay dividends to its public shareholders or anything like that. Does anybody know what the company is? Anybody want to guess? Amazon. That's exactly right. Jeff Bezos is running that company as if he were the founder. And for some reason, his investors are letting him get away with it. He's investing in all this new technology. He just bought Whole Foods. He's buying all this kind of stuff. He's in 18 million different businesses. And so far, the shareholders aren't saying boo about that. Frankly, I think if that ever changes, Amazon's going to go like that. If that ever happens. If the shareholders start insisting on some kind of a return of their investment, that's going to be the end of the Amazon that you know and love right now. And I'm not predicting that that's going to happen, but it's amazing to me. The company went public in 2004, has never paid a dividend at all. They plow all their earnings back into going into all kinds of unrelated businesses. I mean, if you were a shareholder of any other company, you wouldn't tolerate that for 5 minutes. But they tolerate it for Amazon. For some reason, Jeff has been able to weave his magic there and convince people that that's the way he wants to run the company. But that's a very rare thing. Most public companies, are almost run like government bureaucracies. They are. The senior executives cannot move without dealing with at least 50 different SEC regulations that they have to, and IRS regulations that they have to comply with. That's a very big price to pay for becoming a public company. I'm seeing more and more companies now wanting to stay private longer and longer now because of it, because the cost of doing the IPO is just simply too great. You're going to have at least a full team of lawyers on staff to deal with all the regulations that you have to deal with when you're a public company, and that's too much for some companies to deal with. Okay, anything else? Yes, ma'am.
When you mentioned the difference between a project crowdfunding and
equity crowdfunding, yep.
Do they both require the SEC 50 question and answer?
No. The question is, if you do a project fund crowdfunding like on Kickstarter, do they do so? No, the answer is no. You do not have to do the SEC questionnaire. Although most crowdfunding portals do have a set of rules about what you tell your prospective investors, and it varies depending on the website that you're working with. You have to look. Kickstarter and Indiegogo have different rules, so you have to figure out what each of the rules are. So for example, to me, the big thing about project crowdfunding, you always got to let people know what they're getting. In an equity crowdfunding, they're getting stock. They're getting shares in the company. It's clear. In a project crowdfunding, you don't really know what you're getting. You may think you're getting a piece of the company, but all you're getting is a copy of the invention once it's produced. So that's what the litigation has been so far. There's also gift crowdfunding too. If you're a nonprofit or something like that, you can certainly do a crowdfunded offering on Kickstarter for gifts, for donations, where they don't get anything except maybe a deduction. I always tell people, if you're going to do a gift crowdfunding, like the couple who did the in vitro fertilization, that was really a gift. The investors got to name the baby, but they weren't going to get anything else in exchange for that, just the satisfaction of being able to do that. If you're going to do that, you have to be very, very clear to say up front, in your offering documents that unless you are a nonprofit, unless you're a 501c3, you cannot take a charitable deduction by investing in this crowdfunding. You have to be very specific. You can only take a charitable deduction if the crowdfunding sponsor is a 501c3 nonprofit. And there's a list, by the way. If you go on irs.gov, they actually have a list of nonprofits. You can see if somebody's a 501c3. You can actually look it up online. But if it's not, you cannot. You can make the donation anyway, but you cannot take the charitable deduction, the Section 170 deduction. You cannot do that. And you must tell. I mean, I've worked on a couple of gift crowdfundings for my nonprofit clients. I do work with nonprofits too, and I always say you have to state in bold letters you cannot take a charitable deduction for this, for what you're doing, because people will try anyway. You know, if the IRS finds out about that, then you've got a problem. Okay, guys. Listen. Okay, yes.
For convertible note, right? Can you set up the criteria or conditions in 2 years or whatever the condition is?
The question is, if you're doing a convertible note, can you set the terms under which the note? The answer is yes, you can. I mean, generally speaking, it's a negotiation with the note holder. You know, in most cases, the note will automatically convert at a certain time. Or it can be converted at any time at the option of the holder. The holder can decide to convert. What's a little trickier is where you have the right to enforce the conversion. You know, so for example, there'll be a provision in the note which will say, in the event of a qualified private placement of more than $1 million or more of the company's equity securities, the note will automatically convert at that time. It's a very common provision in convertible notes. But you can make it out to be whatever you want. You can make it out, although keep in mind that the crazier it is, the less likely you are going to be, you know, less likely you are to get investment. I mean, don't do things that are so weird that no one's ever seen them before. You know, unless they're in one of my books. I'm known, I mean, I actually have a whole section in some of my law books on creative financing tools. And there's actually some wild stuff out there now. But don't do anything that's not marketable. Investors are actually pretty conservative people. They tend to be with their money. Don't hit them with anything that looks weird, is my advice. Don't, you know, if you're looking for angel investors, offer preferred stock because that's what they want. You know, that's what they want. Set your company up as a Delaware C corporation so that you can offer preferred stock. Don't try to offer some funky hybrid security that no one's ever seen before. It's just going to scare people. You know, even if it's done right, by the way. There's actually something called an equity capital note that I'm surprised more companies, startups don't use. It's basically a note, it's debt, but instead of having an interest rate, the return to the investor is based on the growth of the company. He gets a percentage of the growth in the value of the company year over year, and that's the interest. So it can be 0, it can be 50%. You know, and I'm a little surprised that more companies don't do that, quite frankly. But the investor community just doesn't buy into this. They don't get it. They like to have the security of a fixed return if they're making a debt investment. What's that called?
That term?
Equity capital note is what it's called. If you look it up online, you'll see there's a whole bunch of articles about it. I'm surprised that more startup companies don't use it, but I can understand investors just don't. It's too weird for them. You know, and also too, there's a risk they won't get anything too. If the company declines in value, all the investor gets under an equity capital note is their principal back. They don't get any interest, they don't get any return on their investment, and debt holders don't like that. Equity holders are willing to take that risk, but somebody making a loan doesn't want to have the risk that they're just going to get their principal back with no return, because then they've lost money because of the time value of money. They've lost money at that point. They don't like that. So, okay, one last question, sir.
Going back to the important one in terms of internal capital raising. So you had mentioned in the debt piece that essentially you have to have the interest and it had to be within the 5-year payback, yada, yada. Can you do it as convertible debt, sort of a situation where essentially if the founder puts money in, and again, to sort of skirt that issue of having the valuation, having the interest to pay back, can you have it say it converts into common stock later on down the road instead of being a total debt repayment?
I don't understand what you're saying. So you're talking about a grid note?
Well, it's not really a grid note. So when you're talking about, like, say, the original partners come together, and like you said, they could either do it as a debt piece or as an equity piece. Now, let's say that you want to give the breakout between the 3 partners. If it's 3 partners, 30, a third of each. But one partner will essentially put more money in. But you can't mix. You can't.
Oh, I see your point. So in the situation where Mo, Laurie, and Curly are putting in differing amounts of money,
but you want to still maintain the overall 1/3% within.
Well, that's what the grid note is all about. That's what that does. The grid note, essentially, loans do not have to be made pro rata. Loans can be made any way you want. It's if it's an equity. Now, if you make them convertible notes, though, you got to be careful, because the IRS could look at that and say, well, wait a minute, this is not really debt at all. This is really an equity investment, and because there are differing equity investments, differing percentages for different amounts of money, the ownership percentages are not a third, a third, a third. There's something else. And that creates a problem because that creates tax revenue. Someone who thought he had a 30% ownership who now has a 40% ownership is probably going to have to pay some taxes on that 10%. So I would not take the risk of making them convertible, at least not for the founders. I mean, let's put it this way. In my experience, what usually happens is the minute the company gets a real investor, the investor will say, convert these notes. And here's how much you're going to convert them for. They tell you. And if you want the investor's money, you're going to have to go along with that. That's the reality. The grid note is only a temporary solution to get the company to the point where it qualifies for real investment. Once you qualify for real investment, you don't really want to have a lot of debt on your books, especially debt to founders. You want to get rid of that in any way possible so that you have a clean balance sheet. Any investment advisor will tell you, any financial advisor, that you got to have whenever you go out to the investment community, you want to have a clean balance sheet. You don't want to have debt unless it's debt that you had to incur, at some point to like, for example, a vendor, a supplier, or something like that. That the investors will buy, but they are not going to subordinate their investment to you as the founder. That's not going to happen. They're going to want you to be beneath them. They want you below them. Okay, guys, I'll hang around for another 5 or 10 minutes. You've been a great crowd. This has all been great questions. Hopefully, I've answered more questions than I've raised. But for those of you who are interested, I do have some videos up on my YouTube channel. If you go to youtube.com, search for Cliff Enico, I have a bunch of specific topics that I deal with, and these are all 1-hour videos, and they're all totally free. I don't charge for these at all. Ma'am, who won the book before, is she still here? Did she go?
I answered the question, but I did.
Oh, that was you? Okay, well, I'll give you the. There's no restriction. We will definitely give it to you. So here, give it. This is Michelle, ladies and gentlemen. Yes.
I just wanted to ask you, with the crowdfunding, is there a site that you recommend, or just?
Okay. The question is there a portal I recommend? If you go to the SEC. First of all, go to sec.gov. The Securities and Exchange Commission. If you type in crowdfunding into the search engine, you'll get a page, and one of the things on there is a list of the portals that have registered with the SEC. The portal has to be registered with the SEC. So you don't want to deal with anybody who's not on that list, number one. Okay? Number two, I mean, there are some companies that are focusing on the Title III market in a very big way, but they tend to specialize. Some only do debt, some only do equity, some only do liquor companies, some only do. I actually know there's a crowdfunding portal that's just been set up. They only will deal with companies that are being formed on Native American reservations, because they want to encourage Native American entrepreneurship. So they all have their criteria. I mean, there's one in New York. I mean, if you want to see how one operates, there's one called seedinvest.com. They're based in Midtown Manhattan. I just like their website because they probably have the best content on Title III crowdfunding that I've seen outside of my book. They've done a really good job of really trying to educate the issuers, the companies, on what they're getting into when they do a crowdfunded offering. So that's just one. I mean, I like their ethics. I have no idea what they're like to work with, but I just like what they're doing to try to promote crowdfunding, in the investment community. Seedinvest.com is the name of the company if you're interested. But they're not the only ones that are out there. There's some, very good. There's a portal now that's just been formed. I can't think of the name of it now, but they're doing franchise startups. So if you want to franchise your business, for example, and you don't want to spend the $50,000 to file the FDD with the Federal Trade Commission and do all that stuff, there's now a crowdfunding portal that's focusing on new startup franchises, fast food and that kind of stuff. So you got to find out what their gimmick is and what their restrictions are. It's the Wild West right now. This only came into being in May of last year, by the way, May of 2016. We just celebrated the first anniversary of this, so it's still got a long way to go. And the SEC is going to be looking at it again next year to see how it's going. And it'll be interesting to see what they do with that. I'm going to have to rewrite my book next year. I won't be able to do these score presentations anymore. Okay, guys, I'll hang around for a little bit if you have any further questions. But otherwise, thank you very much. It was great. And thank you for tolerating all the video stuff. I really appreciate that.